Shall I just keep this in my hand, or better to put it back? Okay. Sorry, can you just put that back in the back for me again? Just there. So I'm supposed to do the whole welcome to Astro Labs? Okay. 50. When you go to the back, I'll look at you and take a photo and then take a video of the entire room.
Okay.
With everybody from the back. Go do it now.
Okay.
And I think, is there a flicker? Perfect, that way I don't have to come back. Amazing. And then show it in the mode where it's presentation mode, so you're not seeing all the, yeah. Thank you. So it's just that and that. Yep, perfect. Should be fine, yeah. Oh, it's back. Okay. Excellent. Shall we go? Yeah. Okay, so welcome to Astro Labs and Legal Circles event. Today we're going to be talking about, well, actually lots of things. So I know that the marketing and flyers said we're going to be talking about term sheet do and don'ts, but we're going to talk a little bit more about, and not just that topic, but a little bit more about the whole process and what fundraising looks like, the different instruments that you use, term sheets, what they're used for, some of the things that you can expect to see in there, and lots more. So today really was supposed to be an informal discussion, and I actually thought we were going to be a round table where you can just throw lots of questions at me, but for the moment I think this is the ergonomics and the layout that we have to go with. But I don't want that to deter you from feeling really comfortable and asking me and stopping me at any point in the presentation, because honestly, these presentations are just there for an aid, but we don't need to follow them or stick to them at all. So if there's anything specific that you want to get out of today, I want to make sure that I'm answering those questions, yeah? So to do a quick introduction, my name is Soraya Turk and I'm the managing partner of Legal Circle. Legal Circle is we can call it a boutique law firm. We've been around for about 3 years and a little bit now, and we only focus or solely focus on startups, entrepreneurs, VCs, and supporting them in this space. So space of fundraising, term sheets, shareholder agreements, corporate, commercial, sort of merger, acquisitions, all the way through to exit. So anything from, I guess, the moment you come up with a bright idea and you want to know how to execute it, all the way through to exit, whatever that looks like. And so Legal Circle's a new name in terms of the brand in the area, in the space of the UAE, but we're not at all new lawyers. I've been a lawyer for about 20 years myself, practicing 10 out of 20 of those here in the UAE. And then many of us as well in the team are quite versed and very in this niche corporate commercial law. So that's why we're here today and have partnered with Astro Labs. I'm sure that most people know who Astro Labs is, but I'll just do a quick introduction anyway. So Astro Labs is a technology ecosystem builder which enables and supports the growth of people and companies and innovation across the UAE. So it's been around for 10 years now in the MENA, and they're very vibrant and active and doing an amazing job. And I know because out of all of our partners, they're very proactive and lead the way, which is fantastic. So it's an absolute pleasure to be here today and doing this in collaboration with Astro Labs. All right, so without further ado, let's get started. So as I said today, I know that the agenda on the marketing was term sheets, but we'll talk about a lot more. We'll talk about term sheets, safes, convertibles, co-founder agreement, corporate structures, what are the best ways to structure the company, especially if you're going to be scaling and growing. And then, I guess we can open the floor, as I said, to questions as we go along. No need to hold back on those. Raise your hands or just jump out. So I think I've already told you a little bit about myself. I'm actually an Australian qualified lawyer, so let me give you some goss. I'm third generation Australian, but I have a Lebanese heritage. But I'm born, raised there, educated there, worked there for 10 years before moving across to Dubai, practicing law here. So that's a little bit about me, and I'm the managing partner of Legal Circle. Excellent. So let's get straight into it. I understand. Maybe if I can just quickly ask, I know the people that are streaming into this live won't be able to answer me, or maybe they can, Ahmed. People that are streaming in live, so I can make it a bit interactive. Okay, great. So for those who are looking at me through their cameras and for those that are sitting here today, are you at any stage of a particular startup? Are you in the early stages, mid stages, late stages, or haven't started and just embarking on that journey now? Can I have a few people tell me? Early. Very early, yeah. Like set up a company, MVP. Okay, perfect. Middle stage, so already pre-Series A. Okay, so pre-series, but you've already done a seed round, for example?
Bootstrap.
Bootstrap, fantastic. Yourself? I think.
About to launch in the next year.
Fantastic.
MVP still, yeah.
MVP, amazing. As well. Nice, okay. Same, all right, fantastic. And in the back there?
I'm actually from the other side. I just wanted to get to know more about the startup.
Oh, no worries, perfect, yeah. Oh, okay. Hopefully after today you'll want to. Let's see. All right, fantastic. So even if you're in that MVP stage, very early or mid, you've probably already heard some of these terms. So people are, if you're already talking about fundraising, sorry, I didn't mean to ignore you. Pre-Series A. All right, amazing. So you've probably already heard some of these terms like term sheet, safe notes, co-founder, shareholder, IP assignment agreement, and employment contracts. Obviously, these come at the later stages, yeah? Or maybe not an IP assignment, but IP you might be looking at once you've finalized your product and, if you feel like it's really, really worthy, you might go into this earlier. But really, in the early stages, these are the terms that you're going to have to be familiar with. So a term sheet. So if we think of a term sheet, can anybody tell me if they've ever seen one and been involved in negotiating one or have had to sign one recently? Anybody? Yeah? Perfect. Okay, great. So you probably have already worked out then a term sheet is a non-binding agreement between two parties, and the idea is to nut out and flesh out all of the commercial arrangements between the two parties before they go into finalizing the documents. And usually what we call the documents that come after the term sheet is the transactional documents. So what are the documents that we need to finalize the arrangement? But what a term sheet does is allow you to already start thinking about those little commercial terms that you want to put in there that are very important to the deal. So whilst it's non-binding, what you want to do is put as much as you can in there, use that as your tool to negotiate with the other party so you get a sense of where they're at already. Generally, for example, an investor might give that to you and stipulate his terms, or you can do it the other way around where you give them. So there's nothing set in concrete, but essentially it's let's put our thoughts on a page. How do we get these commercial arrangements aligned so you know what I want and what my expectation is and vice versa? Before we go into the transactional document which we sign and become binding now on the parties. So that's really all a term sheet is. And I remember, when we first started working with startups in the region, and this was years and years ago, but it was always like, these startups would come with this term sheet and be like, I've got a term sheet, and be so nervous about the term sheet. I'm like, it's okay. If you sign, because usually they'd come back with the term sheet after they've signed it and go, but we signed. I'm like, that's okay, because it's non-binding. Most of the time it should be, right? So this is a key term in it. If you've signed something that's binding, that's a little bit different then. But term sheet, most and generally, as we know it in corporate commercial, is an unbinding agreement. And so it sets the scene for later discussions. So let's have a look. Sorry. Let me just go back to one point. When do we use a term sheet? You can use a term sheet pretty much at any stage of the discussion. So it can be for your very, very first investor. It can be if they're going to come in at a safe note or a convertible. It can be, for example, if they're coming in at a subscription agreement. Does anybody know what a subscription agreement is? Exactly, when somebody's subscribing to shares. So there'll be an equity financing round, for example, as opposed to a fundraising round on a safe or a convertible. But you still might see a term sheet before that stage of the equity financing round where that investor comes in and says, all right, well, I agree to buying it at this price per share. I agree that I have these rights on the board. I agree that I've got my drag along and all of the commercial terms. So shareholder agreement, so as well when you're negotiating what terms are going to go in the SHA. So a term sheet can essentially come before any of these final binding agreements. Does that make sense? Okay, so what are the common terms that we find in term sheets? So, I mean, I've already put the answers there. I should have probably not shown you first, but I mean, if you've seen a term sheet before, what are some of the common things, or what do you expect that there would be in a term sheet? Don't look. I know. I've made it too easy. But, right, well, if we pre and post money valuations, right, at the end of the day, anyone who's going to be looking at an investment or investing into your company is going to be concerned about one and one thing only as their first priority, and that is money. Show me the money. It's always the money, right? I mean, the reason why they invest in you is to get a return on their investment. So the first thing you're going to see in a term sheet is money. What are the valuations? How much money are we putting into this company, and how is that going to be converted? What are the valuations in terms of the value of the company, whether it's a Series A or equity financing round or whatever that is? Type of shares. So again, when you have an investor who's investing into your company, it's not necessary that they have the same share as, say, the founders. That can be amended. They can be given shares that have no voting rights, for example, and purely investment to get dividends and a return when dividends are being paid out by the company. So, for example, if there is going to be any limitation on shares and voting, then that is going to go in there as well. Generally, you're going to have an investor saying he wants preferential shares, or which is the right to be paid out in a liquidation event in first priority order. So that's what we'll generally see. Or you might see an investor who's very strategic say, no, well, I want common shares. And there's all this discussion about shares, type of shares, etc. And that's what you'll find in a term sheet. You'll find different rights, again, associated with the shareholder or with the investor when he becomes a shareholder, and things like drag-along clauses. So if there's going to be an exit in the company, what happens to these investors or these shareholders when they become so? Are they going to be dragged along in an exit? Are they going to have the right to say, well, we want to stop because we're not happy with the terms of the sale? What are the terms and rights associated with these investors coming in? All of this should ideally be seen in a term sheet. Now, when I say these terms ideally should be in a term sheet, does that mean every term sheet you're going to have is going to be well drafted? Not necessarily. I've seen term sheets that are like half a page and say, essentially, the investor gives, startup X amount, post-valuation of X amount to have preferential shares. That's it. Very basic, not details. But obviously, I'm speaking as a lawyer, and for me, I always want to know the fine print. I always want the details and to flesh it out. So anytime I see an LOI or term sheet that's too brief, for me, I always want to say, well, I want to see more. I don't want to be surprised in a negotiation when I don't have all the details and then be signing a transactional document or an agreement which is binding, and then suddenly all of the details are in that. It doesn't give you enough time to think. So for me, I always think it's very important to flesh it out. While it doesn't need to be in the most scrutinous detail, it's good to have a very good idea of the whole picture. So things like first right of refusal clauses. Shall I go through the definitions of all these for them to make a bit more sense? Yeah. So drag-along clauses is what I was saying is generally to do with minority rights of shareholders, and usually what will happen is the majority shareholders will have the right to drag a minority in a sale or exit of a company. Pro rata rights is where an investor, for example, wants to be included in a future round. So today he's making an investment, but if he believes in your company, he thinks that your company will grow and scale, he may want to participate in future rounds as well. So he might negotiate some pro rata rights and say, right, in a future equity or future round, not necessarily equity round, but in a future fundraising, I'd like to participate on these terms.
With the same valuation?
Not necessarily. So it depends. So in each round, generally, you see that it will increase. Yeah, yeah. But it might be, for example, that they want a discount to remain the same. So you could be in that round giving other people, a 20%. They want the same. Or, for example, they might have, and I'll go down here, a most favored nation clause. Oh, what did I just do there? Yeah. A most favored nation clause is where the investor says, well, if anybody comes in a future round or in this round, but in the next, so after you've had this discussion with me, and they've negotiated better terms, I want their terms. Right? So savvy investors will put that into their documents. They'll say, well, hang on, I've negotiated what I think is best now, but if somebody comes and does a better deal, I want that deal. I want the same terms. So you might see things like that in there. Exclusivity clauses. Exclusivity clauses generally don't relate so much to investors, but it could be around anything. So we usually see those in term sheets. Board and control matters. This is where obviously if strategic investors might want to be sitting on a board. They might want to have the chance to vote and be involved in who the CEO is. They might say, well, look, we're going to invest in your company, but we want to make sure that the founder is in that company for the next 2 to 5 years. I mean, this whole idea was the founder's concept, and nobody has a more vested interest in the founder. I'm coming in, but on the term that he stays locked in for 5 years. So these are the type of things that you'll discuss in a startup or a negotiation of fundraising round. Condition precedence as well. So often we see those in term sheets, particularly where there's going to be a merger, where there's going to be an acquisition. You might see condition precedence where it says, okay, we're going to be investing X amount of money, but that amount is not going to be invested until we see a number of conditions fulfilled, A, B, C, D. And it could be that, for example, all of the companies, if there's multiple companies in a company, are owned by a parent company, which the investor is going to be investing in. It could be to make sure that there's been an IP assignment of all of the IP to the holding company, so that, I mean, everybody knows IP is mostly what's valuable, particularly in tech companies. So imagine you investing in a company that doesn't have or own the IP, and you work that out later. So your investor might want to say, well, I want to make sure, and the condition precedent to my investment is that all of these conditions are fulfilled. Yeah. So all of those bits and bobs need to go into a term sheet, so that you and the investor, or you and the other party, even if it's not an investor, are on the same page. And that's essentially what a term sheet is. Yes.
So if there is a clause that, hey, we'll invest $1 million when you hit this revenue and this revenue and this revenue, there are stages of investments.
Sorry, yeah, perfect. Yes, yes.
So if there are conditional investments,
right.
So for example, I want to invest 5 million, but 1 million I'll do right now, 2 million once you hit this target.
Yeah.
Do they become a part of term sheet, or?
They can do, yeah, for sure. They can do. I mean, if they want to lock that in now, they'll have that in the term sheet, and then obviously in the transactional document have that binding. But what that's called is vesting. So they will over time be giving you those installments, and that, I mean, that's also, yeah, why not? That should go in.
Or that happens really where, and especially at the pre-seed, say, or seed round, where you have conditional clauses that I invest.
Generally, it's in the earlier stages, and the reason why they would want to do that is so that they make sure that you're reaching your milestone, and as you're reaching them, they have more confidence, and as their confidence grows, and they make more investment. But they don't generally, if they're saying that, then they're sort of erring on the side of caution and thinking, well, why go give 2 million now? Let me give $1 million. If they've reached a milestone, then give my second million, or whatever the amount they're investing. And that's just so that they can test the waters. And it gives you a chance also to see what they're going to be like as an investor. Are they going to be active? Are they going to ask you questions every week? Are they going to be, on to, and to be honest, based on what you've just asked me, if they're doing it in that transitional way, there's somebody who's going to be quite involved in the business, want to see what you're doing, how you're doing it, and give you money. So that's really, to me, sounds like it's smart money. It's somebody who actually understands the space that you're in, is happy to invest, but wants to make sure that you're reaching key milestones. Yeah. So what else? Oh, yeah. Sometimes we see in term sheets, what are the reserved matters? So if there are specific matters that need to be agreed on, for example, unanimously by shareholders, then that can be specified as well. So, you know, this should give you an idea that really anything that's commercial in nature and instrumental to the deal should go in these ideally. And even if it's not everything in the term sheet, at least the most important points that can then be fleshed out in the transactional documents. Yeah? Any questions on term sheet so far? No? You have some? Yeah? Sure.
Term sheets are legally binding, correct?
So actually, oh, you came in at this, you must have come in on that slide. So they're generally non-binding agreements. And the reason why that is as I was explaining earlier, is that term sheet is really about you, and it's a negotiation, it facilitates the negotiation process. And so it's really for you and the other party to be on the same page about what you want to see in those transactional documents. So what happens is when you negotiate the term sheet, then you get to the transactional document or agreement, it makes it easier for the lawyers to draft. We see the term sheet, we see what's negotiated, and we can easily then relay that and put it all into legal terminology and make the parts that we need binding in the agreement that comes after the term sheet. Yeah. So if it is, but you know, always read them, because it could be that you've once seen a term sheet that says binding, yeah? But ideally and generally they're non-binding. Yeah. I think you had some questions, yeah.
I have a question regarding to the board and control matter. Is that based on the term sheet or the equity they are holding? And what is the conditions of like removing the CEO or controlling the company itself? Is that based on how much equity that the investors are holding in the company, or what is, if you can elaborate on this part? Because
Sure.
recently, just the news about the company in Egypt that
yeah,
a lot of
I
conflicts
see. Yeah,
happen.
yeah.
So I want to understand how the investors can get control over the CEO or the founder of the company, and if they remove them, as example, from being the CEO, is he still in control of his shares and every equity? He still hold this and have all the rights,
Good
but
questions.
he's not calling the shots? Or
Got it. Good questions, but there's a lot in there, yeah? So you were talking about the shareholders, you were talking about the CEO there, you were talking about the board of directors, you were talking about equity. So let me try and break it down. So the shareholders at the very, very top level are the people that own shares in a company, yeah? Now, the shareholders will often appoint a director of the company who may or may not be a shareholder to run the operations and the management and the growth and everything of the company. So that director can then be a CEO or not, or he can appoint a CEO. So the director, usually the director's able to do that. Now, who does the director, though, report to? He reports to the shareholders. So it's a shareholder matter to decide on whether they're going to have 1, 2, or 3 directors or more, and they will form the board of directors. And the shareholders will decide on what matters the board of directors can decide on, or what they want to carve out of the board of directors' roles and say, no, this is going to be a reserved matter for shareholders to decide. So, interestingly, in that company, it could have been a board of director matter who was deciding, and there was directors who ultimately report back to the shareholders who were deciding on the CEO, or it could have been that some of the shareholders were on the board itself who were making a determination about who the CEO is. But generally, the high management and C-suite, the shareholders will want to have a say in who is appointed. Yeah? So there is a distinction between the shareholders, directors, managers, and there is there can be a distinction between if they sit on the board of director level or they don't. So when you answer that question of who decided, well, it could be that one of the shareholders was also a board of director, and the board of directors are the ones that decided. Now, how do they decide on a board of director level? That can be, and it's how you choose. It's setting up like the rules of the game. I love corporate commercial area of law. The reason why I say it to people, it's mostly like a game. Think of a game where you decide on the rules within limits. So the corporate commercial law is generally your overarching laws and rules that you must stay within. But otherwise, companies can decide internally how they're going to play and what the rules of the game is going to be. For example, board of directors, they might choose to have one. They might choose to have 2, 3, 4, or 5. They might say all of the board of director matters have to be unanimously decided upon, which means that any number of directors have to all agree to the decision that's being made. Or they can say, no, let it just be a majority of the directors that decide. Or they can say, well, if we've got conflict, let's have a chairperson who comes in and decides. So it's just like setting the rules of a game. How do you want the business to run? How do you want the decisions to be made? And who decides those in a company can be determined and are recorded in the articles of a company. So how many boards, how they decide, if there's a deadlock where they're butting heads, nobody can decide, who decides, all of that. But in that particular situation where you were saying, the CEO was taken out, who was he taking out by? Maybe the board of directors and maybe the shareholders were also on a director level. So then it was both.
He will still keep his equity and shares, but he will not be like in control anymore.
Right. So are you saying where the CEO is also a shareholder?
Yeah.
Yeah. So now the CEO role is an employment role. The shareholder role is an ownership one. So they're distinguishable. But even if I took away or they take away the power from that employee, they can't take his ownership rights, which is different. Yeah. So they're quite different. So he might have resigned or been terminated as a CEO, but in terms of ownership, to get him out, they would have had to pay him out to buy his shares or, do a deal like that. Yeah. So ownership and employment is quite different, and it's much more difficult to remove somebody as a shareholder than it is as an employee. Employee, you just say, well, you've not been performing, we're not satisfied, we've made an executive decision that you're terminated, and they have to comply with the labor laws or whatever it is to terminate. But on a shareholder level, it's not so easy, is it? No, unless they've done something which is absolutely fraudulent, not in the interest of the company, embezzlement or any of that stuff. But otherwise, generally, you'd see that plastered all over the news, and it would, make world headlines. We don't see that often. It's, you have to do a deal. How do you buy them out? How do you force them to sell their shares? All of that. That's where, interesting enough, these come in. Call options, drag along, first right of refusal. So let's say you want to sell your shares. You may need to or be obliged to offer your shares to the other shareholders in the company first before you go public with them. Or call option. Call option's a good one. Call option can actually be a lifesaver sometimes. So if you're majority shareholder and you're going to be exiting, or you've agreed that you want to sell the company, but you've got the minority saying, well, we're not interested in selling. We want to wait till we get a big deal, and we feel that the deal that you're taking on the table is not in our interest at all. They could potentially stop you, even as a minority shareholder, from selling the company. But when you have a call option, what that means, if it's drafted cleverly enough, is that you could call on that minority shareholders option, shareholding, without them consenting. And it can simply be, well, you don't agree to the sale, majority are going to sell, we're forced and we'll buy your shares at, for example, fair market price. You see? So there's a lot that goes into thinking about the mechanics and I guess the rules of the game or the company, but there's a lot that can be done. Mm-hmm.
So if the minority shareholders don't want to sell,
yeah,
and one of the investors wants to exit, the bigger one,
right?
Is it possible that the minority shareholders stay on with their current valuations, current shareholding pattern, and the other one exists?
Yeah, so each individual shareholders can sell their shares and exit at any point in time. If there's first right of refusal, though, they will need to offer it to the other shareholders. If they all say no after a certain amount of time, then he can go and he can sell that share. But you're talking more about an individual shareholder. That's fine. Where it gets tricky is where an investor or a buyer wants to come out and buy out the entire company, so all of the shares and the shareholders on the cap table. That's where then you need the buy-in and you need the minority to sell their shares too. And so often it can get sticky because they don't want to. They're like, oh no, we don't want the money now, or we think that could be sold for a lot more in the future. Oh, we want to hold back. We just don't want to sell. And you've got majority going, but we want to sell. We want to sell the entire company because it's take it or leave it. It's all or nothing. And then it gets a little bit sticky. But then when you have these provisions in there, which don't really give minority shareholders the right to say no and stand their ground, then that's why I say in some situations it's actually a lifesaver. Makes sense? Yeah.
Angel investors, you would always want to have call options.
I mean, it's not that you would always want to have call options. I think personally it's good to have them in there. Whether you can have them in there, don't forget the other party, if they're savvy enough and are advised by lawyers, will review that and may not wish to have those in there. So it all depends on, but if they're quite minority, if they're going to give small amounts of money, they're not looking at a shareholder agreement or say any of that at the minute now because they're raising on a safe and convertible, they won't even likely see those. You won't be having discussions about those. So best to put them in the articles. What I generally do for a company, particularly if I'm representing them, is put all the rights I can possibly put in the articles of association so that nobody can ever really stop us, because we're not doing anything that's in contradiction to our own bylaws of our company. So we put them in there so we have the option and the flexibility. But whether we end up having those in our shareholder agreements to enforce against our shareholders, that then is all depending on the process, the negotiation that we have with the different investors, who's the lead investor, because they will be setting what the terms are. And usually the other investors that are coming in at a smaller amount just follow the lead investor terms anyway. You'll say, these are our lead investor terms. This is what we've negotiated. This is what's on offer for you on the table. Does that make sense? Yeah.
Sorry, one more question.
Sure.
So valuation, when someone wants to exit, what's the legal valuation? Because for private companies, that valuation is not easy to determine, right? So is it the valuation of the previous round that gets counted, or?
Okay, so when we're talking about valuations in the early stages are very much speculative.
Right.
It's what do you think the company's how is the company going to grow, what revenues it's going to generate, how much your technology is going to be worth, so your IP, your assets. So in the early stages, it's very much speculative. In the later stages, there we start to have a fair idea of what the actual valuation of the company is, because by post-Series A, you've started now gaining revenues, gaining tractions. You've got now your amounts that you've raised from fundraising rounds. You have an actual valuation at that point that can be communicated. When you're talking about exit, though, that's now a little bit different. So it doesn't necessarily rely on valuation at that point. It could be that the buyer comes in, you're desperate to sell. And a buyer comes in and says, okay, I'll give you X much for it. It's a take it or leave it. Now we're not so much relying on what the valuation of the company is, although that gives us an idea of what we should sell for. You might be in a situation where you have no runway. Your projections are showing you that everything's just downhill. We're about to hit an economic crisis and you think, uh-oh, now's the time to exit. Let the bigger player in the market buy me. I want out. I want an exit. At that point now, you're not necessarily sticking to what a valuation says. Now it's what can you get? What can you get and how do we negotiate that?
So I was talking more in terms of, suppose our co-founder has 10% equity or even huge number of ESOPs.
Okay.
Right, and they want to leave the company, or you are forcing them to leave the company.
Oh, you're talking about an individual.
Yeah.
Right, okay.
So they would have to get some value out of those 10%, right? And first is there would be accelerated vesting, I assume, right?
Yes, yeah.
And then what's the value that they'll get for 10%? Suppose I was valued at 2 million 1 year back.
Yeah.
But the next valuation round has not happened. So would
Yeah,
be.
yeah. So then in that case, you would look at the valuation of the company, and you would need to look at what percentage of shares they actually own and what the value of that is. Yeah. But generally, I mean, obviously there's more to it than that, right? Because if you're saying they have an ESOP and they're leaving, are they leaving as a good leaver? Are they leaving as a bad leaver? If they've been forced out, you can possibly, depending on how well that is drafted, say, well, not all of your shares are vested, or some of your shares are vested, but it's in our discretion not to pay you those shares out because you're leaving on bad terms with us. So it's not so straightforward. You need to look at what the documentation says. But let's put aside, let's say it's a perfect scenario. They just want to leave. They know that they've got 10% of the company. Then you need to say, okay, well, what is a fair market value of the company right now? What's 10% of that, and pay them out?
Thank you.
Yeah. Any other questions? No? Any questions coming through from online?
We have one question. Does
Sure.
UAE company though allow for the flexibility to draft this type of term sheet, including preferred ordinary shares?
So what was the first part of the question?
Does UAE company law allow for the flexibility to draft this type of term sheet, including preferred ordinary shares?
Right. Good question, whoever asked that. So the UAE companies law, if we're talking about the federal laws, don't make the distinctions and don't recognize many of these principles that I'm speaking about. And that's probably one of the things I should have started with, actually. I'll make a note to put that in our next one, is that today I'm really speaking to you in light of common law, which is like Australian law, Canadian law, American, British. In India, I believe, is also common law. And the reason why we're talking about all these under common law is because the UAE federal laws doesn't recognize many of these. So in the UAE law, it's the federal laws, it's very much more basic in terms of the shareholders and the shareholder rights and ownership. So if you've got X number of company, they're generally ordinary shares. And you can't be limited or restricted and have rules the same way you can under common law. And this is why I talk about common law today, because one, most startups in the UAE and across the globe will be talking about terms that are recognized under common law. Most companies in the UAE specifically, or in the startup space, ultimately end up setting up in the ADGM or the DIFC in order to have these protections in all of their documentation. So today I'm very much focused, good question, good clarification, that these are very much common law principles and nuances and notions that you find, yeah.
I heard this DIFC law is different, right? So
Yes.
common law is more applicable there. versus
Correct.
If you're on the mainland, right?
Correct. So DIFC and ADGM are the two jurisdictions that are common law jurisdictions. So they follow England and Wales laws.
But correct me if I'm wrong, you don't necessarily have to be in the DIFC to have a contract under DIFC law.
No, you don't. You can opt in and have your governing law clause as either ADGM or the DIFC. You can have it arbitration. You can have it, with a seat in London. You can have it England and Wales laws. You can choose. I mean, the parties can agree and determine and decide where the governing jurisdiction and what the law that they want to govern their contract.
Even if you are incorporated in a different free zone, let's say RAC free zone or something, you can opt in for DIFC law as governing law?
Interesting. So yes, RAC ICC, actually, that's another one of the jurisdictions, or because it's an offshore jurisdiction, allows for common law. They do accept, yes. Now, when we talk, let's just pick up on that point a little bit more about jurisdiction. So when you have governing law jurisdiction on your contract, what that means is, in the event of a dispute, you want to go to, for example, ADGM courts in Dubai, and you want your laws that govern the terms of your contract to be England and Wales, right? Now, what happens though if your company is on a mainland, but you've opted in? You would need to then take the judgment from the courts that you've determined to be the deciding courts, and you would need to take that judgment and then have that executed or ratified or accepted and on the mainland. Now, this is where most people get a little bit nervous because I've got a mainland company, I've opted into ADGM laws or DIFC laws, and now I'm implementing it on the UAE or the mainland. Will it be implemented is the question. So I personally and advise everybody to go with ADGM and DIFC, particularly where you're going to be having these discussions with investors and shareholders and you want to protect your interest. But I would also say to, if you can, have a holding company be in the jurisdiction that you've chosen to be the governing law so that you can enforce, that you won't have a problem enforcing or implementing any of the commercial agreements and arrangements that you've agreed on in your contracts. Does that make sense?
Yeah, so what you're saying is if you're not in that jurisdiction, there could potentially be issues?
There could potentially be more difficulties, yes. Okay. Because now you're having a UAE federal court judge, for example, looking at concepts that are common law concepts and then determining how they will fit on the mainland, where there's not a perfect fit, is there? When the infrastructure, the legal infrastructure, is quite different. Yeah. So it's not good or bad. It's just it's the nuances and it's how we navigate around those. Right. Does that make sense?
Right. So yeah, could you just elaborate a bit, like how that looks if it's two, say, mainland entities or non-DIFC entities that are going to sign a contract through DIFC? Do they do that through a notary or a legal firm in DIFC? Or?
No. So you don't need to. Essentially, it's just the contract, and whatever lawyer drafts you can draft that governing law clause and ensure that the laws that govern the contract and the jurisdiction that it will hear the dispute is, for example, DGM or DIFC, and it's literally a very basic clause in the contract,
so
and any lawyer can do
it.
No. Right. So you don't need to go to notary and have it notarized. None of that. No.
Okay. In the beginning, you're like strapped for cash, right? Mm-hmm. Is it okay if you incorporate outside and then form the holding company, let's say, once you see some light down the tunnel?
Yes, yeah, absolutely. There's no need for an elaborate structure, and I'll come down to the structure a bit later, but there's no need for an elaborate structure from the outset. What I tell startups is get going with your idea, get going with your concept, start generating some revenues, bootstrap until you absolutely cannot anymore. The minute you stop the bootstrapping process, start with investment and fundraising and rounds and investors, it's a lot of time, it's a lot of money, it's a lot of energy, it's a lot of knowledge and experience and everything that you're going to need to get through that process. It's not to say don't do it. It's just, whilst you can, build your company up to a level and a position where you can be a little bit more confident when you are negotiating and when you are taking money and when you're saying, well, this is what I think my valuation is and why, and this is why I'm only going to give you 5% and not 20%. We've had, so many times where I've spoken to a, startup and they've been so desperate for money that they've given like 30% of the company straight up for $1 million, because when they were talking about $1 million 2 years ago, it seemed like big money. But now that the company's worth 10 mil, and they know that in the next 6 months it's going to be double and triple because they're in the tech space and the tech industry they're in is just like, is unbelievably, scaling and giving great return. Then they go, 30% for $1 million wasn't a good deal, was it? And that's 30%. Now imagine if that's what you started with, and then you go through the entire fundraising process and you dilute each time. What is the founder left with after that? And what are all the other investors?
Will worth much more at the end of the day. But what you're going to do in 1 year, or in 10 years, you're going to do it in 3 years. But it's about not how many shares you hold. What is the valuation of these shares?
True too. But remember, you're being diluted each time. Okay. So yes, that's right. So your shares are less, and that's why it's okay to be diluted. Your shares are less and the value is more, but also it's more about the control and decision making. So not so much only about the money, because the more ownership you have of the company, the more control you have in the company to decide how you grow and what you do in the company. But if you have less, your value might be great. But if you're a founder who wants to have more control, then you don't want to be diluting. If we put aside what the valuation or value of the actual shares are, what about the control of the company?
So the how many shares you are holding in the company could control if you can keep in control or not?
Well, absolutely. I mean,
And that
you know,
could be something in the term sheet that no matter what is that like the
Yeah,
shares
actually,
you are holding, you're
correct.
still in
And
control.
correct. Actually, what I didn't put up here, and it's just because I ran out of points and I didn't want the slides to be 100 pages long on this, but that could be, for example, if you're, in the early stages, a little bit worried about dilution, you might want anti-dilution provisions in there.
Exactly.
There could be an investor that comes in and says, oh, I want anti-dilution, which means in the rounds, the number of my shares need to increase so that on the total balance of the shares, I'm not diluted less than 30%. So I'm always going to issue myself a number of shares to stay at 30%. Most investors are not going to agree to that because they're going to say, well, no, you get diluted like everybody else does, right? And again, it all comes back to negotiations. But you could in the very early stages try to not dilute yourself for some time. Again, another common law principle that can be found in term sheets and all your transaction or documents where you're not diluted. So that's another one. Good point. Yeah, but you see the difference between the shares, value of shares, ownership, voting, power, control, decision making. Does it all make sense? I know it's a lot. It's a bit of a crash course on corporate law. Tell me, yes. Yeah, sure.
So these new shares which are allocated to new investors,
Right.
these are from unallocated shares, right?
Yes.
So when we form the company, we say we have 1 million shares, but we are allocating only 100 or something like that.
Correct. So the actual word is if you go to the DIFC or ADGM or Delaware or BVI or wherever, they will say authorized shares of the company and issued shares. So authorized shares is the total number of shares that company is agreed in its articles to issue. But the issued shares are the number of shares that are actually given to and held by the shareholders. So we can say, for example, generally what we do is 10 million authorized shares. We issue half to the founders or to the other investors as well. Then we have now remaining 5 million. So if somebody comes and subscribes to the shares, they will subscribe to the number of shares that they're buying for whatever value of the authorized shares that are remaining. The issued shares are now held by the shareholders and investors. Now, what that means is to dispose of those, that particular shareholder owning that share has to sell his shares. In that case, though, there's a difference because money will go, if he sells the shares, money goes to him. Whereas when you're issuing shares from the company, the money goes to the company. And that's why companies fundraise and sell shares, because they want to raise money for the company. Does that make sense?
Okay. Second part.
Sure.
Every time there's an investment, our articles of association change, right?
Yes, so generally, like an investor will want to come in. I mean, angel investors, when you're fundraising on these instruments, safe notes, convertible notes, they won't look at that. But usually in a Series A is where they start to look at articles. They do proper due diligence. Where are your articles? What's your cap table? What if the shareholder agreement looks like? And they will want to see everything. Advisor agreements, if you've got them, who's in your ESOP pool, they want to see it all at that point in Series A. This is where there's going to be an equity financing round. Whereas at that stage, they generally won't ask. I mean, to be honest, I've never, and God, how many startups do we have active at any 1 minute? 30, 40, like at one time where we're dealing with all of this process. Rarely have they ever said, oh, somebody's come and asked me for my articles. I've invested in companies, not even asked about their articles. That's a little bit different though, because I just invested in sort of goodwill. But, articles is where all the rules of the company is. But on this level, they don't generally ask. This level where you've got the VCs coming in, they will ask. A savvy angel investor who's going to be giving you a significant amount of money, they will come in and do a proper legal due diligence most likely. And they'll say, give us your articles, give us your shareholder agreements, give us your ESOP pools, what does that look like? What your cap table, who's on the cap table. In the early stages, though, they will want to ask about the cap table.
And the ESOP pool would be from a tranche of the authorized share.
Correct, yes. So generally the average is about 10% for ESOP pool, and you maintain that through the rounds. So obviously today the people that you have, as your company grows and scales, you'll need more. So they will then increase the ESOP allocation so that it's always proportionate at about 10% of the entire pool of shares that you've already issued. And so you maintain that.
All right. We have more questions online.
Sure.
Do you prefer to go quickly through that?
You're right. How much time do I have? Because I'm
We
just...
have for the question, whoever wants to ask, if you have time, we can.
Yeah.
extend.
Well, if you
But
feel that it's more beneficial for me answering specific questions, we won't worry about the slide, and I'm happy to answer those. You would like to see the slides?
So we can
Okay,
go
no
through
worries.
The slides, and
No worries.
whoever want to stay for asking questions, if you
Yes.
have time, you can.
Sure, sure. All right. So let me quickly go through the slides. Did I answer everything for you? Perfect. Okay. So fundraising instrument. What are the fundraising instruments we commonly see in the UAE and generally across the board and globally? Is safe notes, convertible notes, equity financing. You're looking at subscription agreements because that's where you're subscribing to shares. Now, what is a safe note? It's a simple agreement for future equity. So it means I give you money today on the promise that in the future, when you go to an equity financing round, I'm considered to be an investor and I will convert with similar terms to others in that round. Generally, what we see in a safe note is it talks about preferential shares, and generally there is a valuation cap, and I'll come to the points that you see in a safe note, but I just want you to be clear on what is a safe note. It's as simple as I'm taking money from this investor. I promise to give not the number of shares, but I promise to give shares in a future round based on a valuation. Generally, they will give a discount in the early rounds, about 15 to 20% discount. As opposed to a convertible note. Now, what is a convertible note? A convertible note is very similar to a safe, but it has a debt element to it because it has, look, I promise to give you this amount of money, and sure, when you go to an equity financing round, the money can convert into shares. However, if there isn't an equity financing within, say, 18 months or 2 years, or usually there'll be a maturity date, then I want the money back, and I want you to pay it back with interest of whatever % per annum. So there's a debt element to that. A little bit more risky for the startup, a little bit more safe for the investor. Generally, in the early rounds, we don't see many of these. And we don't see many of these unless we're talking about big money. So I've never seen one, particularly in the UAE with some of the startups, unless they're about 5 mil, 10 mil, 12, 20, 11 mil was the last one I signed. Safe notes, they're usually very common in the seed stage, pre-seed, seed, Series A, then we're looking at the subscription agreement. And then in between that, you can bridge them with a convertible loan note. We see a lot of that happening. Yes?
Can safe notes be governed by UAE law?
UAE law, I do not advise because UAE law doesn't recognize most of these. Yeah? So I've never seen one with a governing law jurisdiction of UAE law. The reason being is UAE law, the law itself, the federals, they don't like this, I take your money today and I give you something in the future. UAE law is very much about fair and equitable principle and dealing in good faith. I give you something today, you give me something in return. It's very much, you gave me money, you get this number of shares. This future equity principle is a very common law thing. In fact, did you know safe notes only came out of Silicon Valley in like 2016? They've not been around for that long. So common law have caught up, and the reason being, because it came out of a common law, but and this idea, a promissory note is very, is probably where the ID started, and that's very much recognised. But safes, convertibles, not really. In UAE law, the convertible loan note debt with an interest component, not really compliant. So that's why we see these mostly in. And to be honest, I've never seen anyone, and I've never advised anyone to do UAE laws for that. So what is an equity financing round? So an equity financing round now is where you've raised enough money, already gone through pre-series, pre-seed, seed. Now you're in your Series A, you've got a valuation for the company, you've got a price per share, it's more of a fixed value, and now you're saying to an investor who comes in, right, this is the price per share, if you give me $1 million, I can give you 100 shares or whatever it is. So it's a priced round. Now that round is what generally triggers these two notes. So as a startup, when you're giving a safe and a convertible, you need to be tracking what terms you've given on these documents, and you need to have all of your investors on a spreadsheet called a cap table. And the cap table, I think I deleted it from these because I didn't want to overwhelm. I didn't know how much detail to go in. We can do a whole nother session on that though. Cap table essentially is a spreadsheet that organizes and arranges, and you can see exactly how your investors will convert on the terms that they convert, and then what the dilution over time looks like. Yeah? Excellent. Any questions on this slide? Shall I move over? Yes?
What's a typical percentage for convertible note, like interest percentage? Is it 4 to 5 or is it 10 plus?
To be honest, it varies. It comes back to negotiation, but the last two we signed, one was on 8% and one was on 12%. Yeah, so they can go as high as that. But obviously, it's in your interest to keep it as low as you can, yeah? If you're the one that's, if you're the startup signing this, if you're not confident that you can meet those objectives by maturity date, I'd negotiate as low as I can on the interest rates.
And then you typically don't give a discount as compared to a safe note where you're giving a discount.
No, you can. So on those, you will. They will want to see a discount too. Most of your investors will want to see a discount. Yeah.
And the whole idea of convertible note is probably not that 5% of sits for interest, but the principal also you have to return, right? The
Correct.
Safe note, if your company goes down, you're not obliged to return that.
Exactly. High risk, lower risk. Lower risk for the investor, higher risk for the startup if they don't fulfill the maturity date and condition precedence in that convertible loan note. Yes.
We have a question online related to this slide.
Sure.
So if an investor invests using safe notes, why will not legally be presented on the cap table? So how will he be shown as an investor?
How will he be shown as an
investor if he is not on the cap table and he invested using the safe notes?
Okay, but my question to that person is, why is he not on the cap table?
Okay.
He should be. Yeah. All of your investors, all of your employees, everybody that's in the company that at some point will get shares should be on your cap table. Yeah, they see me through that, is it? Yeah, so I'm looking to whoever answered that, asked that question, they should be on your cap table. Okay. So safe versus convertible, I've already sort of run through that. Safe notes do not have a term, which means that if a trigger event never occurs, an investor never receives shares. But generally they will. I mean, that's not likely to happen. Interest is not payable on safes, and so the complexity involved in converting interest into equity does not apply. Safes are not a debt, whereas a convertible is, obviously, because of the above. Safes are becoming increasingly popular and appear to be overtaking convertible notes as the preferred early-stage investment mechanisms. Definitely. I can say that without a doubt. For every 10 safe, I see 1 or 2 convertible notes. Amongst the startups, that is. Yes?
So how do you put them on the cap table if you can't, there's no valuation and you can't calculate how many shares they get? Do you just leave it blank?
No, so you actually do have a valuation. So in the safe note and convertible note, you will stipulate what the valuation is. And it will either be a pre-money valuation or a post-money valuation. Now, we would take that pre-money or post-money to work out what a price per share would be, look at how much the investment they've made, do the conversions, and then work out the number of shares they'd get for that money they invested. So you do have, yes, yeah, exactly. So, right on this point, pre and post money value. So the value of a company before it receives cash from a round of financing. Post money value is the value of the company after the investment, obviously, and pre and post money come into value upon conversion of the safe. So we would take the terms of the safe and then plug those into a cap table and say, right, so you've got X number of safes on a post-money valuation with a 20% discount. If they were to convert in this round, which has a valuation cap of 5 million, X number of shares at this valuation amount, then it would look like this. and that's where you would put all of the caps. So when you're then in your next round, or before you get to the next round, you already know ahead of time what amount you could be negotiating and what percentage maybe you give them or don't give them, perhaps, you know, so that you can stay within your sort of financial arrangements, perhaps, or so that your cap table is not fully diluted and that sort of thing. You can start to play around and say, oh, well, I was going to give 20, but I think I need to stick to 15 because otherwise I'm going to heavily dilute myself as a founder and all of the other investors. So all of this, that's where that comes in. Discount rate, same thing. After you've gotten the value of the shares, the discount is then applied to it. So the discount is an incentive for an investor to come in at an early stage. So you give a higher discount then, as opposed to later rounds of investment where you say, well, no, it's only a 10% or it's only a 5%. Generally, early stages, they'll ask for about 15 to 20%. Same thing with the valuation cap. That's where that comes in. So that's how that's the sort of 3 vital pieces of information that we then take, crunch into numbers, and put onto our valuation cap table. So the common mistakes that I see on safes all the time is where, oh, let's just go down and download the Y Combinator template and then issue them out like chips, and that'll be fine. And he gave me $1 million on this safe note, and it's got like Delaware law in America, and your investors over here, and you've got, you know, terms that you don't even understand in your safe. And you think, oh, fine, this will be fine. And then you go to the equity financing round and they all trigger. And you go, oh, I never realized. I signed an MFN in that agreement. He's supposed to get, because, you know, subsequent to him, then I signed another deal on better terms. I need to give that now to him. Sorry. MFN is a most favored nation clause. So sometimes you see these in safes and convertible where they'll do a deal today and say, look, I'll give you $1 million on this safe note with a valuation cap of 5 mil, for example, and 20% discount. But if anybody comes in after me and negotiates better terms than I did, I want the same terms as them. Often people forget that they've done that. So when we're going back to do all the calculations, I go, well, did you realize when you signed that safe that you agreed that if you gave anybody other better terms, so now you've got to give it to him and to him and to him and to him? And they freak out because that all affects the cap table, the dilution, the ownership, the control, everything. When you're not specifying a pre or post money clause, if you don't specify a pre or money clause, how are we now determining the correct conversion? It depends on a pre or post money valuation. So it's super important to have that. Post money valuation is generally what we see in the documents because it works out better for the investor. Overall, when you do the calculations, it gives a better outcome. So they'll most likely want to see post money value rather than a pre. I've seen this all the time where, you know, startups obviously filled it in, puts a discount and says 20% discount. Now, the thing is, though, if you look at the Y Combinator safes, the way they're drafted, they put in a discount rate rather than a discount. And a discount rate means the 20%, for example, so the discount rate is different from the discount itself. If you want to actually give a 20% discount, you would put a discount rate of 80%. So that what they're actually buying is at 20% discounted from the full amount. So if your shares are $100 and you're giving them a discount rate of 80%, you're minusing 20 from 100, they're buying at 80, as opposed to a discount of 20%. So it depends what you put here. It makes a difference to the calculations. Generally, though, look, it is a huge deal in terms of definition, but usually the investor and the startup understand what it means. So even if you put the wrong number in, they get it's a 20% discount. Does that make sense? Your discount rate should actually be 70% or 80% if the actual discount is going to be 20 or 30%. And there's also in the safe note a calculation. There's a clause that actually talks about how that's calculated. So it's important to, you know, make sure that the terminology, the definitions, and all of the numbers are correct. All right, so totally different topic here, but I know that we told people that we would talk about this. So really quickly, by the way, just in terms of timing, I'm fine to go over. Okay. Do we still have lots of people on live tuning in? Oh, fantastic. Great. So I haven't bored anyone to death yet, it seems. Okay, so incorporation, corporate structure. What is the best corporate structure for a startup to protect its investors and to protect the founders and your IP? It's this. On a most basic level, right? Obviously, there's startups who are global. They're coming from everywhere. Their structure might be a lot more complex. But on a very basic level, you'll always be advised to have a vehicle, which is an SPV or a holding. SPV, by the way, stands for Special Purpose Vehicle or Holding, which is separate from your operational entities. And your investors and everything you negotiate happens at this level here. And that's for a number of reasons. One, because ideally you want this to be in a common law jurisdiction, because that's where you can implement all of those things that we were talking about today. And your operational entities can't always be in a common law jurisdiction. They may need to be in the UAE, in one of the free zones, maybe mainland, maybe KSA, maybe Egypt, Pakistan, wherever you're doing business, right? So the SPV is a holding company which holds your investors and the assets that are most important that the investors find valuable, and this is your IP. So an investor always wants to know that he's protected by a holding or an SPV, that the SPV is the one that actually holds the assets and owns the IP because that's what's valuable. And when you sell, that's what you're going to sell, particularly in technology companies. I'm assuming any startup is in technology. I could be wrong, but let's just assume that. And your operational entities are always separate from the holding. Can anyone think of another reason why?
Go bankrupt.
Absolutely. For liability. These ones are carrying all the liability. The service agreements, the transactional agreements, the employment agreements, the company inter-company agreements, everything is happening on this operational level. Yeah? So if any one of these is affected or impacted by it because of any liabilities, it's not impacting this one here. You can always just cut this off and out it goes, away from the entire piece. Whereas imagine you had all of these being stuck with a bunch of investors and everybody's at this point with a liability, insane. And even operationally, when you're making a decision, signing off on matters, deciding whether to open and close, you know, anything that you want to do operationally, imagine having to get sign off from a board of directors or shares or shareholders or investors. You don't want that. So it's much more clean to have everybody on this level and have a manager or a director on this level, and all of your liabilities. That's it. And then eventually all of the dividends or whatever of the company, if there's profits, goes up to its SPV, which eventually gives dividends to the shareholders on that level. Does that make sense? Yeah, sure.
Question. So if the operational entity in the UAE, for example, is a free zone LLC, can the SPV be a RAC ICC, since you mentioned that before?
Yes, yep. Sure can, yeah. RAC ICC, we've seen those. They're the holding companies, and they own then the free zone, or they own it by being a shareholder, and that becomes like a subsidiary of that company. Makes sense?
And RAC ICC can also be in common law.
Yeah, RAC ICC, in fact, yes, because we're doing a couple of those right now as we speak for some of our clients. So yes, it can be according to common laws. Yes, sure.
If you're still in an MVP stage, like a few of us are, at what stage do you actually need the company? Like if you're not generating any revenue, at what stage do you need the operational entity set up before you go into the market?
So two things. In the UAE, as soon as you generate a revenue from anything, any idea, any business, any product, you need to have a license to be able to do that. So before that, not necessarily, but if you're going to be seeking investment because you want money to improve your MVP or to finalize the MVP or whatever they want it to be in a company too. Otherwise, on what basis are they giving it to you and your individual name? There's no protection for them. So they'll generally want to sign with a company. They'll generally want to sign with a company to make sure that investment money that they've given to you is not in your pocket, but rather the company.
You still give it to the SPV, so I set up the operational entity and then the SPV, or does it matter?
Yeah, so what you can do, because the money is going to be utilized on this level anyway, if you don't have the funds to start here, sign it with this operational entity, but let them know that as soon as you set up SPV, you're going to novate the agreement over to the SPV. And most investors are already very well aware of that and know about it, and they will see that that's actually better for them and giving them more protection to be at the SPV level. But if you're bootstrapping and you can't do this setup straight away, set up with your operational, because that's going to help you actually set up a bank account, generate some revenues, actually show some traction and value to that investor. So you sign it in this company name, then sign it over to the SPV once you've set that up in the future rounds, for example.
And you can specify from the beginning that the IP will move to the SPV.
Yeah, absolutely. Exactly.
But
So
you include these innovation terms in the safe notes or something.
you can, yes, you can, or in the term sheets, yeah, anything that you're negotiating. You won't put it as such in the safe. Like, you won't say the SPV is going to be setting up such and such date and we'll move it over. Just that there's an assignment clause or a right to novate. Yeah. And they'll be aware of it. So that's, again, another thing about the term sheet. Good point, where you could potentially say in that there will be a holding company set up and that will transfer. Get them to agree to that already from the outset.
Do you have to have an
Sure.
operational entity in every place that you're trading, even if you've only got a few customers, or can you push them through?
Yeah, you can push them through. So if, for example, it's a service contract, or I don't know what am I doing there? Yeah, you don't have to necessarily have operations and staff and people there. It could be through distribution agreements or agency agreements or an affiliation. If so, like, for example, in the UAE, if you wanted to trade but you didn't have operations here, you'd need to use an agent. So it could be a commercial contract, but you'd need to have something. And the same with other countries as well. If you don't need to set up an operations there's only a few customers, why? What's the point? But eventually that needs to be channeled back to somewhere you actually have a license and an operation, right? Excellent. Let me see what's next. Oh, co-founder. I don't know whether we should go necessarily into this today. Does anybody have anybody that's watching me there have any questions on the other slides? We can keep it to just investments and looking at that, or are people interested to know about this as well today?
If they have, we can maybe, if someone have question, we answer in this, because we
Yeah.
we wrap up this
It's just because I'm mindful of time, and if they've got questions, yeah. I mean, we can do it. I'll be honest, all of these slides, an entire 2 hours can be done on all of them. But I've just put them in there. So would you like to hear a little bit more about co-founder agreements? Or do you want to keep talking about investor? Nod here. No? Shall we keep talking about investment rounds and that?
We
Or
take it in a separate Q&A later.
yeah? Or do you have questions on this?
Yeah.
On co-founder agreements? Oh, for sure, then let's cover it. I'm fine. If everybody's fine, I'm fine to cover it.
everyone is fine, it's fine, but maybe
Perfect. Okay, so importance of a co-founder agreement. Needless to say, everybody knows what founders are, what co-founder agreement is, right? Co-founder agreement is, for those who are listening to me, because I can't see whether you're nodding or not, co-founder agreements is the agreement that governs the relationship between the co-founders who are ultimately shareholders in the company. But generally, the difference is they will enter into this agreement even before they've set up a company, or even before they've got a shareholder agreement in place. And this is, again, a little bit about establishing that relationship with a co-founder, and for you and him and her, or him and her, to be on the same page, and protecting the interests of one another. So what are the key considerations? So business operations. What are the roles and responsibilities of each founder in the business? These are the type of things that you need to be considering. How much time and commitment to the business is expected of each founder? We always see startups, one is doing a lot more than the other because one has left their full-time job, the other's still waiting to leave the full-time till they build enough traction because of their individual circumstances. These are the things we expect to see, right? Very, very normal, but these are the things that co-founders can actually have a fallout about. So from the outset, it's very important to say, who is doing what? What's your role? What's mine? What remunerations? Well, if I'm working full-time in another job and I spend 5%, my co-founder's left his job to dedicate 95% of his time on this, he might need a salary, I might need to wait and maybe have vested shares. Or once I join, then we both have salaries. Or do we have commissions? Or do we have nothing till we raise money? What are you going to agree to? Because these, again, are very sensitive matters that can easily turn sour. Decision making, how are the daily major decisions going to be made? That person that's running the operation day in, day out, can he just make all the decisions without worrying to ask you because you only spend 5% of the time in the business? Or are you so invested in this that every little bit that happens in the operation should be run by you? In case of a conflict, what will happen? You and I are great today, but tomorrow we don't necessarily agree and see eye to eye on certain decisions. Or, if I'm 50-50 though, in a conflict situation, who determines what the decision and final decision will be? Even, sorry?
In that as example, in this specific example, there's like, because in the investment, there's like a director or a chairman who come in. So in that situation, if they are 50-50, what could?
Well, they could still have a third party or like somebody who's, say, on the board of advisors, help them to make a decision, or they just don't make the decision. Like, let's say it's a decision to scale. Do we set up operations in Egypt? One says no, the other says yes. Well, if they can't agree, then they might decide that nothing happens and that they revisit that issue a little bit later. So it's good to have a dispute mechanism in there. Could be a mediation. It could be one of your board of advisors steps in if you've got one, and you say to them, well, look, this is what we can't see eye to eye on. What's your advice? And you agree to take that. So it's really, this is about mitigating your risk before you go into the issues and saying, how are we going to agree to this? And then because you've agreed to that beforehand, then you need to comply and abide with it because you've signed our co-founder agreement. Equity breakdown, investing schedules. Are you going to vest over time? 2 years, 3 years, 4 years. How much are you going to vest? 20%, 25%, 100%, 50%?
Is this legally
Oh,
binding?
sorry. Yes.
Is this legally
Yes, you can make it legally binding, of course, yeah.
How do you do that?
You say in the agreement that this is a legally binding agreement. And that once you have the shareholder agreements, a lot of these terms will go into the shareholder agreements too.
Yes, that was going to be my question. So, in a shareholder agreement, with like vesting, if they want to add like a new vesting schedule in a shareholders agreement, does it supersede the co-founders agreement?
Only if it says it does.
Okay.
So you need to be very clear when you're entering into different documents. If you want it to supersede the other, you must say so. Otherwise, what you end up is having two documents that say do different things that are in conflict, and we end up in the courts that way. So to avoid that, you always want to be clear in the documents and have clear terms that the documents we enter into today supersede anything in oral, anything written, and anything that may have happened in the past between us. Otherwise, you've got problems because it's, then what applies then or what we said now? Make sense? That's why it's super important to be guided by lawyers. I know that lots of startups just want to be like, oh, we can do this, or we'll just sign this document, or we'll wing it, we're bootstrapping, can't afford your fees, we'll come back to it later. But when they get into trouble and they're negotiating a payout, or they just want to get this co-founder out, or take his shares, and because he's just become completely now a nuisance in every sense of the word. Well, it's a bit hard to help if you've got two documents that say the different things, right? There's ways to work around it, but yeah, generally I always advise, find somebody you trust, find somebody who can help you mitigate risk, somebody who's seen it happen before, so they just save you time, energy, and money. Like you might be paying for them today, but they're going to save you a heartache and a lot of money later down the track. And I've seen this many times. Yeah. Sorry, I think somebody has a question. Yeah.
Can CEO, founder, and shareholder fire CEO, founder, and shareholder?
Can a CEO, founder, and shareholder fire a CTO, founder, and shareholder? And what are the conditions for that?
Excellent. So my answer to you is have all of that in your agreements as well. So if you've ever seen an ESOP or a vesting option agreement, all of those terms go into it. Are you a good leaver? Are you a bad leaver? Yes, there is the right to fire them if that is what is pre-agreed. That if I'm not performing, if I'm not, for example, I'm the CTO and I'm not developing the technology that the company needs, and I'm on a vesting schedule, and the company needs to remove me because I'm simply not doing what I'm, arranged to do or commercially agreed to do, then yes. Generally what we find in these, in always the options is, if you're a bad leaver, you can be terminated. Some of your vesting options might be forfeited. So a lot of different things that we can draft into the contract. But if you don't have any of that, and I think that's what this person's asking, if you don't have any of that, and you've already given shares to another founder, then it's going to be very hard to remove them because you're going to have to now negotiate buying the shares off them. And I've seen that go very ugly. What ends up happening is they try to liquidate the company. But to liquidate the company, you need the signatures of both shareholders. You also need them to pay for the liquidation costs. So a lot of the times, what ends up happening is they liquidate. One founder ends up paying for everything just to liquidate, and the other gets off with it and says, well, should have pre-agreed, should have agreed to all of that. I don't want to be out. You're forcing me. Go ahead and liquidate. And they have to try and do that around. So not an ideal situation to be in, especially if you're scaling, growing, raised funds, raised money, all of that. Not ideal. You want to agree and want to have all of that fleshed out in enough detail before you get into that situation so that it's nice and clean. Thank you very much. Speak to my lawyer, but it's all there in black and white. Don't even need the lawyer really at that point because it's very clear. You're a bad leaver. You were assigned to do A, B, and C. You didn't reach the milestones. And according to the contract between us, if you don't, then those shares don't vest. They're forfeited, and I have the right to remove you. Clear as day then. That goes to the courts. Well, what can you argue? And that's the key in all of this, always. Yes?
How early do you usually start working with startups, and what sort of fees can be expected along the way?
We start very, very early. So we start from inception stage all the way through to exit. We've got different type of models in the way in terms of financial models that we work. If you're a very early stage startup, you're not even generating any revenues. Our fees are extremely low, and you can go on packages where there's like a very small amount, and you can talk to some of the team at the back over there, Mr. Yusuf in the white shirt. He can tell you all about that, but sorry, everybody's looking at him. So we've got arrangements where for a small fee each month, and you get unlimited calls where you can just run by your IDs, have sessions like this where you're just like, hey, I'm having a chat to somebody. What do I need to tell them? Or what do I do here? Or, oh, an investor's just told me that. What on earth does this word mean? Or, whatever it is. And we give you unlimited just support. Obviously, when we start to draft things, when it becomes more resource intensive, then we need to increase our fees. But again, we do those incrementally, so we don't overburden anyone. We understand startups, we really do. And then, of course, as you raise money and you grow, the idea is that we grow with you. So hopefully by that stage, you're like, we don't even have to ask you, just say, we love the work that you've done. Here's some extra. No, but we would then increase the fees as you increase, because by that time you've got, raised money from funds. And at that time as well, you need 2 or 3 people working on documents if it's a merger or an acquisition or fundraising round or negotiation. So the more resources we need to use, then the more you need to pay. Yeah, well, exactly, yeah. But in the very, very early stages, we do, we've got like minimum and very minimal packages that just, every month come out, and you book a session through Calendly or get on a phone call, or you get to join us wherever we are. We're having lots of these.
Any other slides?
To be honest, I think, no, because I took us a lot more than an hour actually, but yeah, we tried to just put enough to cover an hour, but you can see how they always go over and over.
So
any other questions?
We have some here.
So I think what we'll do is we'll send you guys an email. We'll send an email out, just thanking you obviously for the webinar, and then we'll have a link there that you can get a call with us and just email us back. We're happy to give you like a free consultation, discuss with you how we can support us. So we're saying we have lots of packages. Even though we're a law firm, you may think we're super expensive, but actually we try to cater for the startup market. We understand you're bootstrapping and you're trying to allocate funds accordingly. So we have various packages, and basically we'll walk you through it. And as Sarah was saying, as you grow, we grow with you. So we say, look, what this is sort of fair exchange.
we can provide you X amount of services based on what you need, and then as you grow, we'll revisit the relationship and look at it long term, because that's really what we're looking at. And this is part of the value add, these educational webinars. Please follow us on LinkedIn and social media, Instagram.
Yeah, I think
a lot of our
they're all
events.
up here as well. Yeah.
We've got another event coming up with Emirates Angels next week, but that's really looking from the investor perspective. So even though you guys are startups, it's still good to sort of understand what do the investors look for, and what do they sort of the lens that they look through, sort of the due diligence that they'll do in other aspects. So yeah, we'll send you the links for that. Yeah, it's 20th of September. It's on our LinkedIn, but again, maybe what I'll do is just in the general email, I'll put our next.
Instagram's got like countdowns and things like that, reminders.
Yeah.
Our Instagram handle is where?
The
this one
bottom
here.
there,
Yeah.
It's a legal.circle. Yeah, don't
Actually,
confuse
we've
it.
also, sorry, I don't think we've got the broadcast group here. But
Okay, so
we've
I
got a
think
WhatsApp broadcast group for all of our startups in the ecosystem, and anything that we've got coming up, we just shoot over in this broadcast group, all the updates.
it's actually
so
that
it's just
number on there. So it's that number. But
Oh,
again,
okay, that's the number.
I
Yeah,
think
perfect.
I think the best thing is in that email that we'll shoot out to everybody. We'll have, join our broadcast group. Follow us on LinkedIn or Instagram. You just choose accordingly.
That's probably perfect. Yeah.
Yeah, sure. Yeah, we'll put it in a
that's-
PDF and send it through.
Sure.
So I think, Ahmed, if you can just maybe send everyone's email addresses.
But not everyone actually signed up, so
Ah.
I don't have all the emails. So I will send to the ones who signed up, but for others if interested, just reach out to
Yeah.
info@legalcircuit.co or my email, ahmed.a@astrolabs.com, and I will put you across.
Okay. Yeah.
Anybody who's not in the system, like they didn't sign up?
Yeah.
Okay. Perfect. No worries.
I will share it with the group.
Sure.
Right, any other questions here in person?
Hi, you're welcome. Thank you. Thanks. I think what might be good too, if we just get a few people just maybe giving a bit of a testimonial, how they liked it, did they benefit from it, or if there's any, maybe we can do it on a little, like did you want to record? How did you want to do it?
Does anybody mind doing it? Just
If anybody wants to give, we attended the Astro Labs session with Legal Circle, found it informative. Anybody wants to give feedback, that would be nice. If not, don't worry. It's no big deal at all. Sorry? Okay, sure. Yeah, no worries. Excellent. Well, that's it for today then, guys. I hope you found it informative. Any questions? Please just give us a yell. Oh, gosh. I just pulled the
questions, so I'll let them send that request to us because we're on.
We didn't answer. Yeah, sure. No worries. Oh, I don't know what I did. I just pulled it out. Excellent. Thanks for coming. Thank you. You're welcome. Take care.
Yusuf has the phone.
Yeah,
I
perfect.
couldn't take all the time because he was using it.
Yeah. No worries. Amazing. Yeah, sure. Hi.
That was fabulous.
Oh, good.
You
Yeah,
guys
I'm
made
so.
my week.
Oh, I'm glad. I'm glad you found it helpful.
Are you guys
Because
going
we
to be
know.
covering the co-founder agreement?
We can. No worries. Take care.
Some session coming up?
We can do so. We've actually got Ahmed.